In this video, we'll show you 3 beaten-down healthcare stocks that could reward patient investors for years and potentially decades to come. These are industry leaders operating in markets with enormous long-term demand, powerful competitive advantages, and business models built to compound value over time. By the end of this video, you'll understand why temporary weakness may be creating an opportunity to buy exceptional companies while many investors are looking the other way. Let's start with the first stock on the list, Intuitive Surgical, ticker symbol ISRG. When most investors think about healthcare innovation, they often focus on new drugs, biotech breakthroughs, or cutting-edge treatments. But one of the most transformative trends in modern medicine is happening inside operating rooms around the world. The way surgeries are performed is changing, and Intuitive Surgical is at the center of that transformation. Before we even discuss revenue, earnings, or stock performance, it's important to understand why this company matters. Intuitive Surgical pioneered robotic-assisted surgery through its Da Vinci surgical platform. Over the years, the company has built an ecosystem that goes far beyond simply selling machines. Hospitals invest millions of dollars into these systems. Surgeons spend years training on them. Medical staff build workflows around them. Once a hospital adopts the technology, switching becomes extremely difficult. That creates one of the most powerful competitive advantages in healthcare. Think about it. A hospital purchases a Da Vinci system. Surgeons become certified on it. Procedures become standardized around it. The hospital then continues purchasing instruments, accessories, maintenance services, and upgrades for years afterward. This is not a one-time sale. It is a recurring revenue engine. And that recurring revenue model is one of the reasons Intuitive Surgical has maintained such a dominant position in robotic surgery for so long. Despite that strength, the stock has struggled this year. Shares have fallen roughly 25% amid concerns surrounding tariffs, macroeconomic uncertainty, and investor worries about near-term profitability. Those headlines have scared away some investors, but when you look beneath the surface, the underlying business continues to execute remarkably well. This is exactly the kind of situation long-term investors should pay attention to. The stock price has weakened, the business has not. In fact, Intuitive Surgical continues to grow revenue, earnings, procedure volumes, and its installed base of robotic systems at healthy rates. The company's newest generation platform, the Da Vinci 5, is helping drive adoption while strengthening its position as the leader in robotic-assisted surgery. The installed base story is particularly important. Many investors focus only on how many robots the company sells each quarter, but the real magic happens after those robots are installed. Every procedure performed generates demand for instruments and accessories. These products have limited lifespans and need to be replaced regularly. Every new hospital customer adds years of recurring revenue potential. As the installed base expands, recurring revenue grows. As recurring revenue grows, earnings become more predictable. And as earnings become more predictable, the company's moat becomes even stronger. This creates a flywheel effect that many investors underestimate. The larger the network becomes, the harder it is for competitors to displace Intuitive Surgical. That competitive advantage is reflected in the company's financial results. Recent quarterly revenue exceeded $2.7 billion while earnings approached $900 million. Procedure growth remains strong globally, and the company continues to benefit from increasing adoption across multiple surgical specialties. What makes this growth especially attractive is that robotic surgery still has significant room for expansion. Many procedures worldwide are still performed using traditional methods. That means Intuitive Surgical is not merely defending an existing market. It is helping create and expand an entirely new category of healthcare. The company continues pushing into additional surgical specialties, increasing the number of procedures that can be performed using robotic assistance. Every new approved application expands its addressable market and creates additional opportunities for long-term growth. Another reason investors should pay attention is the quality of the business itself. This is not a heavily indebted company struggling to survive a downturn. Intuitive Surgical generates substantial cash flow, maintains a strong balance sheet, and continues investing aggressively in innovation. Its financial strength gives management flexibility to expand internationally, develop new products, and strengthen its competitive position over time. The company's leadership position also benefits from an often overlooked advantage: training. Surgeons spend years learning how to perform robotic-assisted procedures using the Da Vinci platform. Medical schools and training programs increasingly incorporate these technologies into their curricula. As more surgeons become familiar with Intuitive systems, adoption naturally expands. That creates a self-reinforcing ecosystem. Hospitals want the technology because surgeons use it. Surgeons want the technology because they are trained on it. Patients increasingly seek hospitals that offer advanced minimally invasive procedures. The result is a powerful network effect that strengthens over time. And this matters because healthcare is one of the few industries where trust, reliability, and proven outcomes can create incredibly durable competitive advantages. Hospitals are not eager to experiment with unproven alternatives when patient outcomes are involved. That gives Intuitive Surgical a level of protection that many technology companies can only dream about. Looking ahead, demographic trends provide another tailwind. The global population is aging. Older populations require more medical procedures. Healthcare systems are constantly searching for ways to improve outcomes, reduce recovery times, and increase efficiency. Robotic-assisted surgery addresses all three objectives. Patients often experience smaller incisions, reduced blood loss, shorter hospital stays, and faster recovery times. Hospitals benefit from improved efficiency. Surgeons gain enhanced precision and control. Everyone involved has incentives to support broader adoption. That alignment creates a long runway for future growth. One concern investors frequently raise is valuation. Historically, Intuitive Surgical has often traded at premium multiples. That concern is understandable. Exceptional businesses rarely appear cheap using traditional valuation metrics. However, long-term investing is not simply about finding low multiples. It is about finding companies capable of generating growing cash flows for many years into the future. The question is not whether Intuitive Surgical looks cheap compared to average companies. The question is whether its future earnings power will be significantly larger 10 years from now than it is today. Given its leadership position, recurring revenue model, expanding installed base, growing procedure volumes, and massive market opportunity, many investors believe the answer is yes. Another factor worth considering is the healthcare sector itself. Healthcare stocks have generally lagged the broader market in recent years, creating pockets of opportunity for patient investors willing to look beyond short-term sentiment. The market often becomes overly focused on temporary headwinds while ignoring long-term fundamentals. That appears to be exactly what's happening with companies like Intuitive Surgical today. When fear dominates headlines, quality businesses can become available at far more attractive prices. That does not mean the stock will immediately recover. Nobody can predict short-term market movements. But investors who focus on owning exceptional businesses rather than timing the market often benefit from periods of pessimism. And Intuitive Surgical checks many of the boxes long-term investors look for: a dominant market position, a strong competitive moat, recurring revenue, global growth opportunities, financial strength, and products that solve real-world problems in a growing industry. Those qualities are difficult to find. Finding them while the stock is significantly below previous highs makes the opportunity even more interesting. The shares remain well below their recent 52-week highs despite the business continuing to generate strong operating results. For investors building a portfolio designed to compound wealth over decades rather than months, Intuitive Surgical may be one of the most compelling healthcare businesses to watch right now. The company is helping redefine surgery itself, and when you invest in businesses that are changing how entire industries operate, patience can become a very powerful asset. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Moving on to the second stock on our list, we have HCA Healthcare, ticker symbol HCA. When investors think about healthcare opportunities, many immediately focus on medical devices, pharmaceuticals, or cutting-edge technologies. But there is another side of healthcare that is absolutely essential to society: the infrastructure, the hospitals, the facilities where millions of people receive treatment every year. And few companies are more important to America's healthcare infrastructure than HCA Healthcare. Before diving into financial performance, let's talk about why this business matters. Healthcare is one of the few industries where demand never truly disappears. People need emergency care during economic booms and recessions. They need surgeries regardless of interest rates. They need treatment whether the stock market is rising or falling. That creates a level of demand stability that many businesses simply cannot match. HCA Healthcare operates one of the largest networks of hospitals, surgery centers, emergency rooms, and healthcare facilities in the United States. Its scale is enormous. Every day, thousands of patients walk through HCA facilities seeking medical care. Every year, millions of patient encounters generate a steady stream of revenue that supports the company's long-term growth. This is not a company dependent on the latest consumer trend. It is deeply embedded within one of the most important sectors of the economy, and that position creates a powerful competitive advantage. Building a successful hospital network is not easy. It requires massive capital investment, regulatory approvals, physician relationships, specialized staff, operational expertise, and decades of infrastructure development. New competitors cannot simply appear overnight. The barriers to entry are significant. That helps protect established leaders like HCA Healthcare. Despite these strengths, the stock has experienced pressure recently. Investor concerns about healthcare policy uncertainty, reimbursement questions, and broader market volatility have weighed on sentiment. As a result, shares have pulled back meaningfully from previous highs, creating what many long-term investors view as an attractive entry point. Fool.com. What makes this situation particularly interesting is that the underlying business continues to perform well. Patient demand remains healthy. Admissions remain strong. The company's facilities continue serving growing populations across many of its key markets. And perhaps most importantly, demographic trends continue moving in HCA's favor. The United States population is aging. As people get older, healthcare utilization increases. More doctor visits, more procedures, more hospital admissions, more specialized treatments. This is not a temporary trend. It is a long-term demographic reality that could support healthcare demand for decades. HCA Healthcare is positioned directly in the middle of that trend. The company currently operates well over 100 hospitals and hundreds of outpatient facilities across multiple states, giving it tremendous geographic reach and operational scale. Scale matters in healthcare. Larger organizations often have advantages when negotiating with suppliers, investing in technology, recruiting physicians, and managing costs. Those advantages can translate into stronger profitability and better long-term performance. And profitability is one area where HCA has consistently impressed. Recent annual revenue has exceeded $70 billion, making it one of the largest healthcare providers in the country. Even more impressive is the company's ability to convert that revenue into substantial earnings and cash flow. The business continues generating billions of dollars in operating cash annually, providing management with flexibility to invest in growth, strengthen facilities, and return capital to shareholders. This financial strength is an important part of the investment thesis. Many investors underestimate the value of cash generation. Revenue growth is exciting, new technologies are exciting, but ultimately, long-term shareholder returns are driven by a company's ability to generate cash and allocate that cash intelligently. HCA has demonstrated that capability repeatedly. One aspect of the business that deserves attention is its diversified service offering. The company is not dependent on a single procedure type or medical specialty. Instead, it serves patients across a broad range of healthcare needs: emergency services, surgical procedures, cardiovascular care, orthopedic treatments, cancer care, women's health services, and many others. This diversification helps reduce risk. If one area experiences temporary weakness, other segments can help offset the impact. That makes the overall business more resilient. Another reason investors should pay attention is the shift occurring throughout healthcare delivery. Many procedures that once required lengthy hospital stays are increasingly moving toward outpatient settings. Some investors initially view this as a threat to traditional healthcare providers. For HCA, it can actually represent an opportunity. The company has invested heavily in ambulatory surgery centers and outpatient facilities, allowing it to participate in evolving healthcare delivery models rather than being disrupted by them. This ability to adapt is critical. The strongest long-term investments are rarely the companies that resist change. They are the companies that embrace change and position themselves to benefit from it. HCA has shown a willingness to evolve alongside the healthcare industry. That adaptability strengthens the investment case. Now let's discuss one of the most attractive aspects of HCA Healthcare from a valuation perspective. Unlike many healthcare growth stories that trade at elevated earnings multiples, HCA has often traded at relatively modest valuations compared to its earnings power. The market sometimes discounts hospital operators because investors worry about labor costs, reimbursement rates, and regulatory changes. Those concerns are not entirely unfounded. Healthcare is a complex industry. However, long-term investors understand that uncertainty often creates opportunity. When high-quality businesses trade at reasonable valuations due to temporary concerns, patient investors can sometimes achieve attractive returns over time. The key is determining whether the underlying business remains fundamentally sound. In HCA's case, many of the core indicators remain encouraging. Demand remains strong, cash flow remains substantial, market position remains dominant, and demographic tailwinds remain firmly intact. Labor costs have been one of the biggest concerns for hospital operators in recent years. Healthcare systems across the country faced staffing shortages and wage pressures following the pandemic. These challenges affected profitability throughout the industry. However, HCA's scale once again provides an advantage. large organizations are often better positioned to recruit, retain, and manage healthcare professionals than smaller competitors. As labor markets continue normalizing, many investors expect some of those pressures to ease. If that happens, profitability could benefit. Another overlooked strength is HCA's local market leadership. In many regions where it operates, the company enjoys strong brand recognition, physician relationships, and established patient networks. These local advantages can be difficult for competitors to replicate. Healthcare decisions are often based on trust. Patients trust hospitals with proven track records. Physicians prefer working within systems that provide strong resources and support. These relationships take years to build and can create durable competitive advantages. The healthcare sector also benefits from a characteristic that many investors appreciate: predictability. Nobody knows exactly what the economy will look like 5 years from now. Nobody knows where interest rates will be. Nobody knows which industries will be the next major winners. But healthcare demand is relatively easy to forecast. People will continue needing medical treatment. An aging population will continue requiring more care. Healthcare spending will remain a critical component of the economy. HCA Healthcare is positioned to benefit from those realities. For investors seeking a balance between stability and growth, that combination can be extremely attractive. The company may not always generate the excitement associated with emerging technologies. Its story is not built around futuristic concepts. Instead, it is built around delivering essential services that society depends on every day. Sometimes the most successful long-term investments are not the most glamorous. They are the businesses quietly generating billions of dollars while serving fundamental human needs. That description fits HCA remarkably well. The stock's recent weakness has caused many investors to focus on short-term risks. But long-term investors often ask a different question. Will this business likely be larger, stronger, and more valuable 10 years from now? Given HCA's scale, market position, financial strength, and favorable demographic trends, there is a compelling argument that the answer is yes. And that is precisely why HCA Healthcare has earned a place on this list of beaten-down stocks that investors may want to consider holding for the long haul. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move on to the third and final stock on our list, Abbott Laboratories, ticker symbol ABT. If there is one characteristic that separates truly great long-term investments from average ones, it is adaptability, the ability to evolve, the ability to innovate, the ability to remain relevant through changing economic cycles, technological shifts, and healthcare trends. And few healthcare companies have demonstrated that ability better than Abbott Laboratories. This is a company with a history stretching back well over a century, yet it continues to find new ways to grow, expand, and create value. That longevity is not an accident. It is the result of building a business designed to serve essential healthcare needs across multiple markets, multiple generations, and multiple economic environments. Before discussing financial performance, it is important to understand why Abbott occupies such a unique position within healthcare. Unlike many healthcare companies that depend heavily on a single product category, Abbott operates across several major healthcare segments. The company has significant businesses in medical devices, diagnostics, nutrition products, and established pharmaceuticals. This diversification provides stability. If one segment experiences temporary challenges, other divisions can help support overall performance. That makes the company less dependent on any single growth driver. It also gives management multiple opportunities to create value. This diversified structure has been one of Abbott's greatest strengths for decades, and it continues to be a major advantage today. Despite those strengths, the stock has struggled over the past year. Investor concerns surrounding healthcare spending trends, slower growth expectations, and broader market uncertainty have contributed to share price weakness. Yet the company's underlying business remains remarkably resilient, which is precisely why many long-term investors are paying attention. Fool.com. One of the most compelling aspects of Abbott is its exposure to several powerful healthcare trends simultaneously. Take medical devices, for example. This segment includes some of Abbott's most important growth opportunities. The company has built leading positions in cardiovascular care, diabetes management, and other critical healthcare categories. Among its most successful innovations is the Freestyle Libre continuous glucose monitoring system. This technology has transformed how millions of people manage diabetes. Instead of relying solely on traditional fingerstick testing, users can continuously monitor glucose levels throughout the day. The result is greater convenience, improved disease management, and better patient outcomes. What makes this product especially attractive from an investment perspective is that diabetes is a growing global health challenge. As diabetes prevalence increases around the world, demand for effective monitoring solutions continues to rise. That creates a long runway for future growth, and Abbott has already established itself as one of the leaders in this market. But diabetes monitoring is only one piece of the story. The company also maintains strong positions in cardiovascular devices. Heart disease remains one of the leading causes of death worldwide. As populations age and healthcare systems continue prioritizing cardiac care, demand for innovative treatment solutions is expected to remain strong. Abbott's portfolio places it directly in the middle of this trend. Then there is diagnostics. Healthcare providers depend on accurate testing to diagnose illnesses, monitor treatment effectiveness, and improve patient care. Diagnostic testing remains a foundational component of modern healthcare. Abbott's diagnostic business provides another source of recurring demand and long-term relevance. The nutrition segment adds yet another layer of diversification. Products designed for adults, children, and specialized medical needs continue serving consumers around the world. People may delay discretionary purchases during economic uncertainty. They are far less likely to stop purchasing essential nutrition products. This helps support business stability. When you step back and examine the company as a whole, you begin to see why Abbott has remained successful for so long. It is not dependent on one breakthrough. It is not dependent on one market. It is not dependent on one customer group. Instead, it participates across multiple areas of healthcare, creating a business model that can adapt as industry dynamics evolve. Financially, the company continues to demonstrate impressive resilience. Annual revenue remains above $40 billion, supported by contributions from several business segments. Strong profitability, healthy cash generation, and a solid balance sheet provide management with the resources needed to continue investing in innovation while returning capital to shareholders. That balance between growth and stability is one reason so many long-term investors appreciate Abbott. Some healthcare companies offer rapid growth but significant risk. Others offer stability but limited upside. Abbott occupies an attractive middle ground. The company benefits from steady demand generated by essential healthcare products while also maintaining exposure to innovative technologies that can drive future growth. This combination can be particularly valuable during periods of market uncertainty. When investors become nervous, they often seek businesses with durable demand characteristics. Healthcare frequently benefits from this dynamic because medical needs do not disappear during economic downturns. Patients still require treatment, hospitals still need equipment, doctors still depend on diagnostic tools, and consumers still purchase healthcare products. Abbott's broad portfolio allows it to participate across many of these areas. Another reason Abbott deserves attention is its culture of innovation. Some investors mistakenly assume that mature healthcare companies eventually stop growing. Abbott's history suggests otherwise. The company continues introducing new products, expanding existing platforms, and investing in research and development. Innovation remains central to its strategy. That commitment helps ensure the business stays competitive even as healthcare technology evolves. Let's also discuss dividends. Many investors seeking long-term wealth creation appreciate businesses that reward shareholders through consistent dividend growth. Abbott has established a reputation for returning capital to shareholders while continuing to invest in future growth opportunities. Over long periods of time, reinvested dividends can play a significant role in total returns. The combination of capital appreciation and growing income streams can be particularly powerful for patient investors. Demographics once again support the long-term thesis. The global population is aging, healthcare consumption generally increases with age. Chronic diseases become more common. Demand for diagnostics rises. Medical procedures become more frequent. Monitoring technologies become more important. Nutrition needs expand. Virtually every major segment in which Abbott operates stands to benefit from these long-term demographic trends. That does not mean the journey will always be smooth. Every stock experiences periods of volatility. Every company faces challenges. Every industry encounters uncertainty. The goal is not to find businesses that never experience setbacks. The goal is to identify businesses capable of overcoming setbacks and continuing to create value over many years. Abbott's track record suggests it possesses that capability. The recent decline in share price has caused some investors to focus on short-term concerns. Long-term investors may see something different. They may see a globally diversified healthcare leader. They may see multiple growth drivers. They may see durable demand. They may see innovation. And they may see an opportunity to acquire shares at a more attractive valuation than was available previously. That is often where the best long-term investments begin. Not when optimism is at its peak, not when everyone is talking about the stock, but when strong businesses temporarily fall out of favor despite maintaining attractive long-term fundamentals. And that brings us back to the bigger picture. All three companies featured in this video operate in healthcare, but each approaches the market from a different angle. Intuitive Surgical is transforming how surgeries are performed. HCA Healthcare provides critical healthcare infrastructure and patient care services. Abbott Laboratories delivers diversified healthcare solutions across diagnostics, medical devices, nutrition, and pharmaceuticals. Different business models, different growth drivers, different competitive advantages. Yet all three share something important. They operate in industries supported by long-term healthcare demand. They possess meaningful competitive strengths, and they have experienced stock price weakness that may be creating opportunities for patient investors. No one knows what the market will do next month. No one knows what headlines will dominate next quarter. But investors who focus on quality businesses and long-term fundamentals often place themselves in a stronger position to benefit from future growth. That is why these three beaten-down healthcare stocks deserve a closer look. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Which of these three businesses do you believe has the strongest long-term competitive advantage? Intuitive Surgical's robotic surgery ecosystem, HCA Healthcare's massive hospital network, or Abbott Laboratories' diversified healthcare portfolio? Let us know your thoughts in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.